Preparing for a financial solutions advisor at Bank of America interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through your understanding of the financial solutions advisor role at Bank of America. At Bank of America, a financial solutions advisor connects banking clients with investment guidance, planning conversations, and Merrill solutions. I see the role as both advisory and relationship-driven. Understand goals, risk tolerance, time horizon, and current financial picture, then recommend appropriate strategies within compliance standards. The value is helping clients move from transactional banking to a broader wealth plan while deepening trust across Bank of America and Merrill. While answering, focus on the blend of financial planning, investment guidance, client relationship management, Merrill platform usage, compliance, and the role's connection to Bank of America's broader banking ecosystem. Question 2. Why do you want to be a financial solutions advisor, specifically with Bank of America and Merrill? Bank of America interests me because the platform combines everyday banking scale with Merrill's investment depth. As an advisor, that matters because clients rarely have isolated needs. Cash flow, credit, retirement, and investing connect. I also like the structured advisor development culture, compliance discipline, and strong brand trust. I would use that ecosystem to have practical planning conversations and bring in the right specialist when a client's need goes beyond my scope. Make sure to cover the strength of the Bank of America and Merrill platform, client reach, advisor development, planning culture, compliance standards, and your motivation for helping clients make financial decisions. Question 3. How would you approach your first meeting with a new client? My first meeting would be discovery, not pitching. I would start with rapport and confirm what prompted the conversation, then gather goals, income, assets, liabilities, time horizon, risk comfort, tax considerations, and liquidity needs. I would ask open-ended questions and summarize back what I heard. Only after that would I discuss possible next steps, required documentation, and suitability. The goal is to earn trust and build a plan around the client, not a product. In your answer, talk about discovery before recommendation, rapport building, goals, risk tolerance, time horizon, liquidity needs, financial profile, documentation, and avoiding a product-first conversation. Question 4. How do you determine a client's risk tolerance? Risk tolerance is the client's emotional and financial ability to handle volatility. I would assess it through questions about past investing behavior, loss capacity, time horizon, income stability, liquidity needs, and goals. A young investor may have capacity for risk, but still panic during downturns, so I separate willingness from ability. Then I document the profile and align recommendations accordingly, because suitability starts with understanding risk accurately. Be sure to mention willingness versus ability to take risk, investment horizon, liquidity needs, prior investing behavior, income stability, goals, documentation, and how risk tolerance drives portfolio suitability. Question 5. What information do you need before making an investment recommendation to a client? Before recommending anything, I need a complete client profile. That includes objectives, risk tolerance, horizon, liquidity needs, financial situation, tax considerations, investment experience, and existing holdings. Then I evaluate whether the recommendation fits the client and whether lower cost or simpler alternatives should be considered. I also explain benefits, risks, fees, and trade-offs in plain language. If I cannot support the recommendation with documented facts, I should not make it. While answering, focus on know your customer requirements, client objectives, risk profile, time horizon, liquidity, tax situation, investment experience, current holdings, fees, alternatives, and documentation. Question 6. A client calls during a market sell-off and wants to liquidate their portfolio. What do you do? I would first acknowledge the client's concern, because fear during volatility is real. Then I would revisit their goals, time horizon, asset allocation, and cash needs before discussing any action. If the portfolio was built for long-term retirement, selling after a sharp drop may lock in losses. I would show historical context, rebalance if appropriate, and identify whether their risk profile has truly changed. The key is calming emotions without dismissing them. Make sure to cover empathy, revisiting goals and time horizon, avoiding emotional decisions, assessing liquidity needs, rebalancing, risk profile changes, historical context, and clear documentation of any recommendation. Question 7. How would you balance sales goals with doing what is right for the client? Sales goals matter, but they cannot come before client needs. I would manage goals by building a consistent pipeline, scheduling proactive reviews, asking for referrals appropriately, and uncovering needs through discovery. If a solution fits, I explain it clearly and ask for commitment. If it does not fit, I walk away. In financial advice, trust is the long-term revenue engine, and unsuitable recommendations create client harm, complaints, and reputational risk. In your answer, talk about ethical sales, client-first advice, pipeline discipline, proactive reviews, referrals, suitability, long-term trust, reputational risk, and why goals should never override compliance. Question 8. How would you partner with Bank of America Financial Center teammates to generate quality referrals? In a financial center, collaboration is critical. I would build relationships with bankers by being responsive, professional, and helpful with their clients. I would educate partners on signals that indicate an advice need, such as excess cash, retirement questions, inheritance, business sale, or college planning. When they refer someone, I would close the loop without violating privacy. That creates confidence that I protect the relationship and represent both Merrill and Bank of America well. Be sure to mention relationship building with bankers, educating partners on advice triggers, protecting client trust, timely follow-up, privacy awareness, closing the loop, and representing Merrill professionally. Question 9. What does regulation best interest mean for an advisor working with retail clients? Regulation best interest means recommendations to retail clients must be in the client's best interest, not driven by compensation or firm incentives. Practically, I need to disclose material facts, understand the client's profile, consider reasonably available alternatives, and manage conflicts. I would document why a recommendation fits and explain fees and risks clearly. For Bank of America and Merrill, strong compliance is not separate from advice. It protects clients and the franchise. While answering, focus on acting in the client's best interest, disclosure, care obligation, conflict management, reasonable alternatives, documentation, compensation conflicts, and how compliance supports client trust. Question 10. How would you build and manage a book of clients as a new financial solutions advisor? I would build a book through disciplined daily activity. That means reviewing assigned clients, prioritizing opportunities, calling with relevant reasons, conducting annual reviews, asking for referrals, and partnering with branch teammates. I would track follow-ups in the CRM and measure conversion, not just activity. Early on, consistency matters more than charisma. Clients respond when I bring useful ideas, listen well, and follow through exactly when I said I would. Make sure to cover daily activity discipline, assigned client outreach, CRM usage, proactive reviews, warm referrals, pipeline management, follow-up consistency, conversion metrics, and adding value in every interaction. Question 11. Explain asset allocation and diversification in a way a client would understand. Asset allocation is how a portfolio is divided across stocks, bonds, cash, and other assets. It matters because allocation drives much of long-term risk and return. I would connect it to the client's goal. A 30-year retirement account can usually take more equity risk than money needed for a home purchase in 2 years. Diversification reduces concentration risk, while periodic rebalancing keeps the portfolio aligned with the plan. In your answer, talk about dividing investments across asset classes, matching allocation to goals and time horizon, managing risk, avoiding concentration, rebalancing, and explaining concepts in plain language. Question 12. How would you help a client think through retirement planning? I would start by quantifying the retirement goal. When does the client want to retire? What income do they need? What assets exist? And what guaranteed income sources are available? Then I would review savings rate, account types, investment mix, taxes, inflation, Social Security timing, and healthcare costs. The advice should identify gaps and trade-offs, such as saving more, retiring later, or taking different risk. Retirement planning is really cash flow planning over decades. Be sure to mention retirement age, income needs, assets, liabilities, savings rate, Social Security, healthcare, inflation, taxes, account types, investment mix, gap analysis, and trade-offs. Question 13. When might an annuity be appropriate, and what risks would you explain to a client? Annuities can be useful when a client values income certainty or tax deferral, but they are not one-size-fits-all. I would explain the type, guarantees, surrender charges, liquidity limits, fees, riders, and insurer credit strength. For example, a retiree worried about outliving assets may benefit from guaranteed income, while a younger client needing flexibility may not. The key is matching the product to a specific planning need, not selling complexity. While answering, focus on income certainty, tax deferral, retirement income needs, liquidity constraints, surrender charges, fees, riders, guarantees, insurer strength, suitability, and avoiding product-driven recommendations. Question 14. A prospect says your advisory fees are too high. How would you respond? If a client challenges fees, I would not get defensive. I would clarify what they are comparing, then explain the value of advice. Planning, asset allocation, behavioral coaching, risk management, monitoring, and access to the broader platform. They would also be transparent about costs and alternatives. If a lower cost option is better for the client, I should say so. Credibility comes from helping clients understand value, not hiding the price. Make sure to cover listening first, understanding the comparison, transparent fee discussion, value of planning and advice, alternatives, lower cost options, and maintaining credibility rather than being defensive. Question 15. A client is unhappy because their portfolio underperformed. How would you handle that conversation? I would separate performance from process. First, I would confirm the benchmark, time period, risk level, and client objective, because a conservative portfolio should not be judged against the S&P 500. Then I would review asset allocation, manager performance, fees, concentration, and whether circumstances changed. If the strategy is still sound, I explain why patience may be appropriate. If not, I recommend adjustments and document the rationale. The conversation should be factual, not defensive. In your answer, talk about listening, comparing performance to the right benchmark, reviewing goals and risk level, explaining market context, evaluating process, recommending changes if needed, and avoiding defensiveness. Question 16. What would you do if you felt pressured to recommend a product that was not suitable for a client? If I were pressured to recommend something unsuitable, I would not do it. I would explain the client facts that make the recommendation inappropriate and propose a compliant alternative. If pressure continued, I would escalate through my manager or compliance channel. In this role, one bad recommendation can damage a client's financial life and the firm's reputation. I would rather miss a sales target than violate suitability, Reg BI, or my own integrity. Be sure to mention refusing unsuitable recommendations, explaining the client facts, proposing compliant alternatives, escalation channels, documentation, Reg BI, reputational risk, and placing client interests above sales pressure. Question 17. How would you explain the relationship between interest rates and bond prices to a client? Bond prices generally move opposite interest rates. If rates rise, existing bonds with lower coupons become less attractive, so their prices fall. Duration helps estimate sensitivity. A bond fund with a duration of 5 years may lose roughly 5% if rates rise 1%, before income effects. For clients, I would translate that into portfolio impact, income needs, and time horizon, rather than making it sound like a textbook formula. While answering, focus on inverse price rate movement, coupon attractiveness, duration as sensitivity, bond funds versus individual bonds, client-friendly language, income needs, and portfolio impact. Question 18. How would you know when to bring in a Merrill specialist, private bank partner, or other Bank of America resource? I would recognize when a client's needs exceed my lane. A mass affluent client may need retirement planning and managed portfolios, while a business owner with estate, lending, concentrated stock, and tax complexity may require Merrill specialists, private bank, credit, or trust resources. I would not try to be the expert on everything. My job is to identify the need, coordinate the right team, and make the client experience feel seamless across Bank of America. Make sure to cover recognizing complexity, business owners, concentrated stock, estate needs, lending, tax-sensitive planning, trust services, not overstepping expertise, team-based advice, and seamless client experience. Question 19. Describe how you work in a team-based financial center environment. I work best with partners when expectations are clear. In a financial center, I would align with managers, bankers, mortgage, small business, and Merrill partners on client needs, referral standards, and follow-up. If there is tension over ownership, I would focus on what serves the client and communicate early. A strong advisor does not operate like a solo producer. They multiply the branch's relationships by being reliable, responsive, and client-centered. In your answer, talk about partnering with managers, bankers, mortgage, small business, and Merrill colleagues. Emphasize clear communication, referral standards, client ownership issues, responsiveness, and shared client outcomes. Question 20. Tell me about a time you faced rejection or lost a sale. What did you learn? Early in a sales role, I lost a prospect because I talked too much about product features and not enough about the client's real concern. Afterward, I reviewed the conversation, asked for feedback, and changed my approach. Now I lead with questions, summarize the client's priorities, and only then present options. That failure helped me become more consultative. In advisory work, rejection is useful if I turn it into a better process. Be sure to use a concise STAR structure. Show accountability, explain what went wrong, highlight improved listening or discovery, connect the lesson to advisory sales, and avoid blaming the client. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.